Control over credit transactions. This relates to the controls that accountants put on the receiving of all accounts, namely accounts receivable, and the accounts that we have to pay, namely accounts payable. First of all, we have to look at what is a credit transaction. A transaction that occurs when a good or service is sold, but obviously with a promise to pay, usually within 30 days. So it's on credit, so it means hopefully it will be paid, or in the case of accounts payable, that we will be paid. The first question I want to ask you is why would a business give credit? Importantly, they do it to increase their sales, they would attract further customers. In a lot of instances their competitors are doing, therefore they have to respond to it, and also in a lot of cases it's convenient to customers, especially customers who go back to the same business. For example, if you're a supplier, you might get one or two things per day or a number of things per month, so we will then collect all the invoices for the month and pay in one lot at the end of the month. So from that point of view it's a lot more convenient. So let's just look at a business, Clearwater Pool and Spa, and a supplier to that business. So if we deliver suppliers for cash to the Clearwater and Spa business, we would buy goods, they get delivered, and they then hopefully straight away, or if it's done on EFTPOS, an electronic funds transfer, they will pay the cash to us. So that's a cash transaction, but we're talking about credit transactions. So in this instance, if we are buying or if we're delivering goods to Clearwater and Spa, from our perspective, if it's a credit transaction, we're going to receive the money, but from their perspective, the Clearwater and Spa, they're the ones that bought it. So from their perspective, they're going to pay for that transaction. Therefore, in their records it will be accounts payable, and for us, having sold it, it's accounts receivable. So they're going to deliver supplies on credit, supply goods worth that amount, and they then would have a liability for $5,500 under their accounts payable system. So let's look at it from the point of view of the seller, that's us. So we're selling. So the first general journal entry that we must make is that we have created a debt which is payable to us, Joe Spas, for $5,500. Remember, there's a GST component and the sales component is $5,000. But as well as that, assuming that those supplies cost us $3,000, we've got to recognise the cost of goods sold and a decrease in our inventory levels. From the other perspective, the Clearwater Spas, which I called Joe Spas before, they have increased the level of inventory, if it indeed is an inventory item. The GST credits received, from their perspective, they're going to get a rebate from the government, but importantly they've generated accounts payable to the supplier, that's us, for $5,500. And the liability they must obviously pay back, hopefully within 30 days. So that's the two types of credit transaction from two perspectives. Each of those businesses would have a separate general ledger, and they call that a separate general ledger a subsidiary. It's a ledger separate, detailing all the individual accounts. So from my perspective, if I'm selling to the Spa business, I would have a subsidiary ledger card for that business. Conversely, the supplier that we sold to, from their accounts payable perspective, would have an account for us. And they would have multiple accounts depending on how many suppliers and customers the respective businesses have got. Also, to note here that the total of all accounts in the subsidiary ledger accounts is shown in the general ledger as, in our case, accounts receivable control. So all our customers, all our debtors, they will be detailed individually in the subsidiary ledger, but the total is under this section. And similarly for the amounts that we owe, we have all our suppliers totaling up in our accounts payable control account. In the past, you would have just seen accounts receivable and accounts payable. Okay, what this means is that the control account means that controls the total of all the individual items in the respective subsidiary ledgers. Now, when we talk about credit transactions, we also need to talk about the topic of bad and doubtful debts. Now, it's inevitable that some debts are not going to be paid, and we call those debts going bad. And this is called a bad and doubtful debts expense, and in the income statements it's allocated as a finance expense. Now, what happens when we as accountants have to account for bad debt? Let's go through an example. An account to M. James for $500 is declared bad, so it means they have been declared bankrupt. In this particular instance, and this happens quite a lot, that maybe only 20%, or in this case 20% of the debt can be paid. So what happens? We have to come up with a general journal entry, which looks as this. On the date, we've incurred the debt. So let's just do some calculation here. $500 was outstanding. We received 20% of that. So 20% of 500 is 100. So we received the 100, which the remainder, which is 400, we then have to classify as bad debt, and that is an expense to the business. And the original debt to M. James of $500 obviously doesn't exist. We're never going to get it. Therefore, we must credit the accounts receivable control account M. James. When we get to the end of the accounting period, there's something else we must do. I've already told you that customers don't pay for various reasons, and that happens from a day-to-day basis, and sometimes that is determined on what the economic conditions are like. In any instance, what we must do, we must estimate what proportion of accounts receivable might not be collected. That's usually based on past experiences and also expectations from an economic perspective. So if things are going bad in the economy, therefore we might expect our level of bad debts based on the past experience to go up. Therefore, we have to make a provision. The reason we do this is that we must attempt to match potential bad debts to the revenue earned in that accounting period. So accountants follow the doctrine of conservatism, which means they are conservative. Therefore, if they think that an asset value might be less or profit might be less, they must make some adjustment. And we're going to make an adjustment called provision for doubtful debts. But to come back for the matching principle, a debt which could be classed as doubtful and provide a potential expense, we must make that attempt to match the potential expense in that accounting period to that corresponding revenue. So if a sale is made in one accounting period and there's a potential for that sale to go bad, or any potential sales to go bad, then the provision for doubtful debts creates a expense, a doubtful debts expense, in that particular accounting period to ensure that the matching occurs. In order to make a provision, we have to write a general journal entry. In this instance, we debit bad and doubtful debts expense. I'm just making this up, $250, and we create this account, provision for doubtful debts, and I'll show you in a moment where it gets allocated to on the balance sheet. If we want to decrease the provision, what we need to do, we need to go the opposite way, and we're going to create a provision for doubtful debts and debit bad and doubtful debts expense. There'll be a example that I will show you later in a future clip to show you exactly the dynamics of how creating provision works and how it affects the doubtful debts expense account and also the accounts receivable control account. This is how it would look in the balance sheet in the current assets section. So you can see that's just a little excerpt. So you would have a heading here, current assets. You would have other current assets like cash at bank, inventory control account, and so forth. But this is the important bit. Accounts receivable control in this receivable control account is $100,000. The provision or the allowance for bad debts is $5,000. Therefore, the net that we're going to receive is $95,000. But as accountants, we want to understate rather than overstate. So realistically, we're going to receive $95,000 and not the total $100,000 that we have in our accounts receivable control account. That's it on the theory side. As I said, I will present another clip to account for the provision for doubtful debts, which will explain it in a lot more detail. Thanks for listening.